Christine, take it away.
Hello, everyone. Welcome. It's the moment we've been all waiting for this morning in light of how tumultuous everything is. Jason, just so you know, on your feed, I am only seeing you and not Barry and I. I don't
Oh,
know if we
oh,
need to go to a
yep. Hold
gallery
up, hold
effect.
up. Yep, I changed it.
But
It
yep,
will, it will, it will take a few seconds, but it will go.
I'm your tester over here, and I know I want to share that over to my Facebook as well. I'm going to take 2 minutes to do that before we dive in. Everybody, to get it as to many places as we possibly can get it right now. So just boom, boom, boom. And then that way it is streaming in all areas. So, okay. Good morning, everyone. Here we are. We have Barry Habib today. Before we get started, and I hand it over to Barry, I want to, on behalf of the banking industry, the mortgage industry, brokers, mortgage lenders, I want to thank you, Barry, because, in times of crisis like we find ourselves in, both personally and in our industry for the last few weeks, we have relied heavily on communication, on good information, because there's so much there's such a high level of economic news and so much volatility that we've got to get it right. We have to understand it in a way that we can reiterate it. You've done that. You've showed up. I know you've given so many live interviews, and we're thankful to have you here today at 2020 Vision and Mortgage X podcast to put it out to the world. So number one, thank you for that gift. Of your time and of your knowledge, number one. And then number two, to everybody listening that is tuning in, share this right now on your Facebook feeds, because what that does is it amplifies the audience for all of us, and it brings it out to the world, and more people will click in and join us. We want you to get ready to ask questions today. Jason Frazier, my fearless partner in crime, is going to be reading the questions through the feed. I will be bantering a little bit with Barry, but mostly staying out of his way. I do want to say a few economic things. Obviously over the last 3 weeks, we've all been here. We know what's been happening. We know there's been volatility. We've seen the Fed make attempts to lower the rates. We know that has affected the mortgage rates in strange ways because of different things. We understand the climate right now. In the last 24 hours, we've seen the biggest deterrence of our economic and the mortgage industry that we've seen. Yesterday, we saw a pulling back of government-backed securities that has affected lenders across the nation. Obviously, we saw a non-QM effect at the beginning of the week. This morning, job markets came out. I want to remind everybody that just 2 weeks ago, we were at a place of 220,000 people unemployed. It was predicted this morning that we might see 1 million. It was 3.4 million unemployment jobs. So we are in unprecedented times. I think it's important you all listen. I think it's important you take notes. And I think it's important you understand that we are in unprecedented times right now. And I say that with a tone of seriousness. I want to give optimism. I think we all want to give optimism to the world. We don't want to be dramatic at this time. A lot of people are comparing this to 2008. We have some of the same symptoms. We got here a different way, but I do want you to know that we can all play a part in how we react to all of this. And we need to listen to our leadership right now because they're doing preemptive preservation movements. With that, I'm going to hand it over to Barry Habib. Good morning, Barry.
Well, good morning, everybody. And thanks for your kind words. I want to say the same to you. And you don't have to thank me. This is just what we're supposed to be doing, right? We're all supposed to be doing the very best that we can to help each other in any way that we possibly can. So I'm really proud of our industry. I'm proud of the people listening, and I'm proud of the leadership that we have. It just, I've had a chance, Christine, to talk to pretty much every leader in our industry for every large firm out there recently, and many of the analysts that are out there, many of the smartest minds in the financial world, people that have been on the Fed like Lacey Hunt and Danielle DiMartino, and just brilliant people like Peter Bookvar, John Walden, Ivy Zellman, and the list goes on. And how about David Stevens, who's been unbelievable as a leader always, and has been really helping us out to try and get information that we can really rely upon so that we can best navigate this. But the leaders in this industry, we're really fortunate that we have so many smart and really just genuinely good people that
Yeah.
want to do whatever they can. So I want to take a minute to just say that. Now that said, team, we're in for a really serious discussion this morning. I want to tell you that it's going to be a sobering talk. It's a very serious talk, and I put an article out in MBS Highway, but I'll make it available to everyone, and I think it'll break down a little bit what I'm going to tell you. You may want to take some notes here, because perhaps maybe for the first time we're going to understand how the mortgage industry works. And I'm going to break this down for you. I think we've got a good way to communicate this to you that will be understandable. And what I think it'll be is extraordinarily eye-opening and educational. But I also think that it's going to get at times a little bit scary. What I want to tell you is that I have every confidence that we will come out of this in good shape, but there's measures that we have to take to ensure that. So I'm going to start with this, is that you got to stop thinking like a borrower, and you have to start thinking like a CEO. And that's the CEO of your business, your future, your family's future, because I don't want to understate this. That's what's on the line right now. People that compare this to 2008, 2008 in some respects could be a little bit worse. In others, it's a cakewalk. There's never been anything like this. Certainly the government is taking this far more serious than 2008, just by the numbers that are occurring. The loss of jobs, the loss of revenue makes 2008 look like it was a blip on the screen. But 2008 was a demand issue, meaning there was a lack of demand. This is very different than that. We headed into this with some really good metrics in the economy. Now, we were probably going to be heading for a recession anyway, because it's only natural, but it would have been a shallow recession. However, 2008 had much more systemic and serious problems. Here we had a pretty darn good economy, pretty darn good housing and mortgage market, pretty good interest rate environment. And after this is over, we should resume that trend. It might take a little bit of time. So let's start with the biggest problem, is that everything would fall into place if this virus would go away, right? So I've been in touch with Dr. Mike Roizen, who I've had on interviews. Christine, I know you and Jason have seen some of the discussions. Yep. I talk to him 3 times a day. He is Dr. Oz, Mehmet Oz's partner. They are running studies currently at the Cleveland Clinic. There's also studies in New York. And what I would like to tell you is that we've got mostly optimistic news, but there is this morning, he just spoke to me this morning and said there is a concern that he has. So I'll give you both, because
yeah, please do.
We want to give you the good and the bad and the ugly, right? All at the same time. So here's what we know. These studies are showing that hydroxychloroquine, along with azithromycin, you guys may know it as a Z-Pak, as a cocktail in a specific dosage, has been proven in a small study to be highly effective as a therapeutic response. Now, when we talk about a therapeutic response, it's not a vaccine. A vaccine would hopefully really eradicate this. But
right.
When we talk about a therapeutic response, here's what we know. We know that in a small study that took place, I got a copy of the study in France. I posted the graph in MBS Highway. What we know is this, is that within 6 days, everybody got better who took this. We know that within 3 days, 90% of people got better. And we also know that the main point about this is they stopped shedding virus. So that truly limits transmission. Now, we should be getting data on this next week in massive trials, not in small trials, in massive trials. And Dr. Roizen said you need at least 40, and they've got much more than 40 in the places that they're doing this. So it is my prayer and hope that by next Wednesday, we know that we have a therapeutic response to this. So you're probably thinking,
one question,
okay,
Barry, not to interrupt you. The first drug, the Z-Pak, is the second one, and you said it very well, like a doctor in the Latin term. What's the first one translated down layman terms?
If I told you how many times I was going to say it and I screwed it up, because I've said it's a high. So I've
you
screwed
did
it up
great.
a lot.
Is it Tylenol? Is it, what is it? If we're making the cocktail and it's a Z-Pak is the second part, what's the first part?
Hydroxychloroquine, which is an existing drug. It's manufactured, Bayer manufactures it. It's done to treat malaria. It's used to treat malaria, I should say.
You need a prescription to get that part.
Definitely need a prescription. And it is in back order right now because as some of this has leaked out, people are taking precautionary steps to get it. It's on back order. But
The good
next
news
question-
is we've got it. We know
the good news
this is having
it's approved
effects.
already. It's usable and it appears to be working. Although by next Wednesday we will know for sure that it's working. And just let me give you a little bit more background on this. So Dr. Roizen also said in news from DARPA that they can really up the production of this. If we get good results, within 10 days, we should have ample supply to treat people. And this is so important, Christine, because there's some scary numbers here, okay? The scary numbers are is that this virus in the United States is doubling in its rate of infection of reported cases. Now, there is problems with, do we get good reporting? Is there, I understand all that. All I'm saying is the raw numbers are doubling every 2 days. So if we've got 60,000 cases here on the 26th, on the 28th, that would suggest that we'd have 120,000 cases. On the 30th, it would suggest that we have 250,000. By the 1st of April, that would suggest 500,000, 1 million by April 3rd, 2 million by April 5th, 4 million by April 6th.
And you're in the epicenter. Like, where
in New
you
York,
actually,
let me just finish this. By April 10th or so, 10% of the US population would have it. So we need to truly flatten the curve. Now I'm in New Jersey now. I have a place in Florida that I can't get to, but I'm in New Jersey, and in New York, they have been extraordinarily hard hit. Now, what he also said was, that's why you hear this flatten the curve. That's why flattening the curve is so important. And that's why this therapeutic response is critical. But in this morning's update from Dr. Roizen, there is fears because they could not understand why the death rates and why the transmission went crazy in Italy, but yet in Korea it was kind of much more mild. And they've looked at everything. And now what they're suspicious of is that this virus is mutating and there's a second strain. And that could be very problematic unless we really get this thing corralled. So that's a wrinkle. That was some bad news. But I'm still very optimistic by next week we do get some good news, because here's the thing. All this other stuff we're about to talk about, it all gets better if the virus stops.
Right.
It's that simple.
Right. That's the solution. People have been asking that. And I said, we have to flatten the curve. We have to see somebody said, see the whites of the eyes of recovery. We have to bridge that peak. So guys that are tuning in, please share this on your pages so we draw a larger audience in, because this is gold to have Barry Habib here with us this morning. And he is a busy, busy man, and he's full of great information. We're going to get into a deeper economic discussion, and we want your questions. We think it's important. We know what you're thinking, what you're asking. So don't be afraid to write those at any time. Jason Frazier is going to play MC, and he will read them at a later time. So
let's go deep and let's really understand what the impact is to our industry and to the economy. So, Christine, as you had outlined, the initial jobless claims numbers were staggering, to say the least. And when you take a look at, as you mentioned, where we were 2 weeks ago, it was 210,000 people filed for unemployment for the first time 2 weeks ago. Okay. Last week, a week ago today, that jumped but to 280,000. Well, this week you added 3 million to that. And it's suspected that many people did not actually file for unemployment or haven't lost their jobs yet. So this number is expected to more than likely continue to be at very elevated levels. Now, remember, this is the first time filings for unemployment. So it would be, you would anticipate that this is the big shock, and then it drops to still very elevated numbers. But what you want to look is the continuing claims. And based upon what we are seeing, and I've been trying to follow this very carefully, that's in the relief or stimulus package for coronavirus, they're now extending unemployment benefits from 26 to 39 weeks, but also bumping them by up to $600 a week. And the fear is this, guys. Here's the fear. And listen, I hope that nobody's a bad actor on this, but I just wonder, are there people out there that are going to say, well, I'm actually going to make more if I stay home, and I can now stretch this out for a longer period of time? And here's my fear. And I've been talking to a lot of very wise people about this as well. And here's what we're thinking. We're thinking that, God willing, when this thing eventually goes into more of a hibernation like it typically does in April, and when things settle down and when we actually get back to work, and President Trump has already given some guidance as to Easter as a target. And I think it's because he's thinking that the hydroxychloroquine along with the Z-Pack will really change our outlook on things. If we indeed do that, then what I feel is going to happen is we are all, Christine, you said to me, and Jason, you said to me before the call started, how are you? I said, how are you? How's your health? You said, you both said, we're star crazy. And I would anticipate that that's what a lot of people are feeling. So when we get some sort of, okay, let's start to get back to things, I anticipate a demand spike.
Yeah.
I do not think we get a corresponding supply spike as quickly because it will take time to ramp things up. And if people now may be incented to not come back to work as quickly because they are feeling pretty good about the benefits that they're receiving. And I'm not saying that's going to happen, but you just have to try and.
Yeah, but even history, look at history, right? 2008, when we had default go from 4 to 42%, the numbers back then showed 50% of that 42% were first time ever default. So investors couldn't have predicted that these people who had never defaulted on their mortgages would do so for the first time. So some of that was the, oh, they're going to have credit reform. And of course, we've seen some credit, foreclosure and eviction have been obviously halted in the US right now. We know if people fall victim to mortgage default right now that, there'll probably be some direction from the US Senate or from the government in terms of how we handle that default, how the agencies are guided to handle that. Well,
I'm going to break this down so everybody could clearly understand it. So just allow me to kind of explain to people how that works. But to finish the point with the initial claims and the problem with this, that this package, hopefully it just does a lot of good, but that you may have a spike in demand without a corresponding supply to meet it until a period of time. And what that potentially could cause is a spike in inflation, because in our economy, when you have more demand than supply, prices tend to rise. So that can create some problems, that can create some volatility. So I'm just bringing that up there as something to look out for. And that mortgage rates hate inflation. So now, whether or not that's transitory, it's something that we still have to understand. So listen, I'm going to go deep with you right now. Okay. So let's just spend the next, I'm going to take about 15 minutes here to explain to you, maybe for the first time, how the mortgage industry really works and what's going on, and while the Fed's unintended consequences is contributing to the most horrific perfect storm that Stephen King is not even creative enough to come up with something this horrific. Okay. So let's do it. Okay. I'm going to start a tiny bit pedantically, because it is important that every single one of you watching this understand exactly every step of the way, because it's about to build. So before we start here, if you really want to know, put your phone down, shut off your email, focus, because you're going to need to use 100% of your brain power to follow this. This is really high level. I'm going to break it down so you can listen and understand it. But if you're going to be distracted, then you might as well shut it off. Okay. Because it's not going to make sense, and you'll miss out on an opportunity to tell every person what they really need to hear. If you want to be a beacon of light and explain what's going on, and if you want to respond correctly, then please listen carefully, and you may want to even take notes, because this is critical information. So here we go.
Rock.
How does the mortgage work? How does the mortgage business work? So you have a borrower that wants to take out a loan. And that borrower goes to an originator to do that loan for them. The originator doesn't hold the mortgage. They want to get rid of that. Maybe they pass it on to a servicer, or maybe they service the loan. Now, the servicer plays a critical role. And what does the servicer do? They do not own the asset, but they collect payments, pay the taxes, pay the insurance. They give you, they'll send you a nasty note if you're late. So the servicer literally services the loan, hence the name servicer, but they don't have any ownership. They offload this to an aggregator, or to Fannie or Freddie or Ginnie. So what they do then is they don't want to hold this hot potato either, but they have the ability to collect these in large bundles within a short period of time. And timing is important, because you have market moves in the meanwhile. So you have to get economy of scale, large bundle, rapidly. And they have the ability to do this because they aggregate from everyone. Then they go to Wall Street, and they go to your Morgan Stanleys, your Goldman Sachs, et cetera, et cetera, et cetera. They go to investment banker, and then the investment banker, they take it and they underwrite it to turn it into a pool of securities, which then gets sold in the open market. And people who buy it are everybody listening to this call. If you look at your 401ks, your IRAs, your mutual funds, we own this. So why does nobody want to hold on to it? Well, remember, you have to turn over money so you can redo it. Right. Except that the big thing here is that, think about it this way. If you were lending money, let's say you're lending me $100,000 at 3%, and I pay you early, and the credit's all good, and the LTV is super low, and everything's good. You might say, oh, that's a great loan. I know I'm going to get paid on that loan, except you're on the hook now for 30 years. if rates were to go to 4, 5, 6%, if it goes to 6% in the open market, who in the world is going to buy your note at 3%? Who wants your 3% when I can get 6%? Okay, so if you were to evaluate, which you have to do something called market to market. You have to mark that security to the current market, mark to market security, or if you want to sell it, in a 6% market, your 3% security is worth half price. So your $100,000 loan is worth $50,000. That's a game nobody wants to be in or play. So what do? Everybody takes a piece and offloads it. And we have a beautiful mortgage market system that functions this way. Now, the borrower who borrowed the loan at 4%, by the time everybody takes a piece, when that same borrower gets the return as an investor, it's in a 2.5% or a 3% coupon. That's why you look at the 2.5 or the 3% coupon when your mortgage rates are 4. So this is how our mortgage market works. And if we understand that, then we understand the role of the servicer. And the servicer now, what they will do is they will perform this important function, but in order to gain the right to service, they have to pay for it. And let's say rule of thumb, I want to use simple numbers. The rule of thumb is 1% is what they'll pay. So on a $100,000 loan, they'll pay $1,000, and now they could service that loan. But the servicing of that loan means that for doing that, they get something called a strip. They get a fee. You're doing this service, you're going to get paid for it. So they pay their point, they get the servicing, and they get about, let's just use some round numbers, between 30, 35 basis points a year for that loan. So they paid $1,000, they're making $300 or $400 roughly a year on this. So do some quick math. It'll take about 3 years to break even. So it's kind of like a customer who pays a point on a loan to buy their rate down.
Right.
Invested the money, but it takes time to see the benefit. Same thing that a lender does with servicing. So they put this out there. They say, I'm going to service this loan and I hope to keep it for 3 years or so I could start making money. Now, mortgages typically stay on the books for 6 or 7 or 8 years. That's normal. However, when interest rates start dropping precipitously, what starts to happen? You start refinancing people, and if people start refinancing within a year, well, then that servicer said, man, I paid 1%. I got back 30 basis points. I lost 70 basis points on that transaction. Now, one transaction is one thing, but could you imagine with the volume we have, how much money is being lost in servicing? So it is bleeding on the servicing side when you get runoff. It's called runoff because your portfolio runs off. Now, when rates drop, this is what happens. But if you're originating loans as a servicer too, then you hopefully are making it back on the origination side. And this kind of balancing act is what mortgage companies kind of have to always kind of keep in mind for their health. Well, under normal circumstances, you can tolerate this, except add the coronavirus in there, right? So the coronavirus comes in, and now you add a new variable. And that variable is, will I make the payment? Because with these levels of job loss, people aren't going to make payments. So that's why you saw mortgage-backed security pricing hurt. And that's why servicing levels, value of servicing started to take a hit. Add to this now, the government, I'm from the government and I'm here to help. And what they want to do is they want to add help, but they don't necessarily contemplate all the steps. So when the government says forbearance means you don't have to make your mortgage payment if you've been affected. Well, we know a lot of people will be affected by job losses here, right? So imagine all these mortgage payments ceasing.
Yeah.
Let me explain to you the thing that I bet you virtually no one knows on this call is this. If you're a servicer, you have to advance the payment. The
principal
to the
of payment.
Investor.
Right?
You have to advance the payment to the investor, whether or not you receive it from the borrower.
Yep.
Now, with normal delinquencies of 30 days of 3.6%, with normal 90-day delinquencies of 1.2%, I can deal with that, okay? But now, if delinquencies rise to 40 or 50%, the government says, don't worry about paying your mortgage, I can't deal with that. So this was what was destroying servicing values, and servicers were panicked. Now, 2 nights ago in Washington, they contemplated a fix, but we don't know how it's going to be fixed. But they fixed one thing, they didn't fix the other. The first thing that they fixed, they said, okay, listen, we're going to create a facility. Now, I don't know how long it's going to take to access money. Nothing happens instantly. Where if you're a servicer, you would be able to access and borrow money from here so that you could pay the investor. So we don't know how this is going to pan out, how much is it going to cost, and how quickly it's going to take place. But at least it's contemplated. But here's what they didn't contemplate. What they didn't contemplate is there is a covenant as a servicer that says this: if you have a first payment default, the loan is no longer saleable. Now, it
No
might
longer
be
eligible.
if you get 6 months later on where they paid, then you can potentially make it re-eligible for sale. But here's the thing. If you've got forbearance on all these, and think about the volume of loans that you've closed where their first payment is about to come up in the month of April or May, and if those people default on their payment because of forbearance, servicers aren't going to be able to handle this. And now many of you are asking, why did non-QM go away? Why is government showing much more difficulty? Why is jumbo? Why? Because if you take a look at the non-QMs or the Govy loans, these transactions are inherently riskier. They're riskier on two fronts. Why? Because these people have elevated levels of ratios. Perhaps their credit is not as sound. These are many of these borrowers, many of them are borrowers that have a much more difficult time withstanding an economic hardship. 32% of Americans who are working would have to borrow money if they got an unforeseen bill of $400. Think about that. Okay. So what would happen to these people is that these people are in the front lines. So that's why you saw Govy lending kind of really be in a situation where it's either stopping or struggling, because the servicing value for government loans, there is absolutely no bids on right now.
Yeah. And if you don't mind, just to interject, yesterday we saw the reaction of that across the industry, and it unfolded in many different ways. It unfolded in margin compression, which led
I'm going to talk, not compression.
No, LO compensation reduction. Yes. And then also, whatever it takes to slow that government engine down, right? I'm
going to go into that, Christine. There's a chronological order I'd like to follow just because I want everybody to stay with us. So I prefer, if we can, I don't want to jump ahead and take a piece here because I think that would make it. I think if we follow this step by step, I've thought this out very well.
Absolutely.
We'll be able to get people from point A to point B and they will understand it all.
I know that's the burning question for my
I promise to get
people.
to it. I promise I have it, but I want to give you the building blocks so that when we talk about it, everybody.
So stay tuned. We'll get to those answers.
You got it. So here we go. So now let's get back to the fact that you now have no bids in the government market, non-QM. You can't get these loans easily sold off or serviced. So that's creating a lot of pressure in that particular marketplace. Now, even on conventional transactions, while it is still functioning, we have to figure out this first payment default issue, because what this is going to do is create massive issues. And even on the conventionals, the servicing value got slashed 36 hours ago from 1% to 0.5%. Now you're going to be listening and say, okay, so big deal. Well, how does that affect me? Here's how it affects you. Because if servicing is 0.5% now, it affects you in two different ways. On conventional loans, if it's 0.5%, that means that if you're a mortgage lender, what you've done is you've had this servicing portfolio, and in order to maximize profitability on it, it's smart business for you to finance it. So let's just say I financed 50%, I put up cash for 50%. Well, if it just got whacked in half, to use a mortgage term, I'm at 100 LTV. The broker dealer says, sorry, your max LTV is 50, cut me a check. And I am hearing staggering numbers of checks having to be written. Here's a compounded effect. It affects your net worth. The way the banking system works, you can loan a multiple of your net worth. Your warehouse lines are based on your net worth. So you either have to come up with cash to increase your net worth, or you have to restrict to some sort of lending ability. So these are very, very much like a Rubik's Cube. There are many aspects to it, but there's a lot more that I'm about to get into. So now when we take a look at this huge drop in servicing, it affects your pricing, because many people are saying, look, we still have to do some government loans. So there are many lenders out there that say, we'll do the servicing ourselves. So we'll book it at zero. Now, if you're going to do the servicing yourself, in the past, if you were to take that transaction and sell the servicing, you'd get a point, you'd pass it on to your rate sheet. Or if you're booking it, it counts as an asset of 1 point, you could pass it on to your rate sheet. If you're booking it at zero, that's an instant 0.25% rise in interest rates that you have to account for, and people need to understand that. Okay, but there's more. We're just getting rolling here. Now, let's take a look at what's happening in the interest rate environment. Now, the Fed, who does not understand this, and I've got a lot of people that are talking to folks from the Fed with articles that I've written so that they can understand this and maybe stop what they're doing, is the Fed is making it much worse, and I'll explain why. So here's the deal. You have a customer and you locked in their mortgage. When you lock a customer in at, let's say 4%, it isn't like some, some mystical character says, okay, it's locked, poof, everybody's happy. It's not locked. All it is promised to be locked.
Right.
So company promises that individual that they will lock their loan, they will give them a loan and deliver a loan on their mortgage at 4%. So what happens is that that loan is floating until it closes internally. So if it were to go to 4.5% by the time of closing, when your company's ready to deliver it, they have to physically pay to buy it down from 4.5 to 4 to keep their promise to the customer. Now, once they've done that, that's fine, except they're out a lot of money. What if my whole pipeline got destroyed like that? What do I do? We have a mechanism for that. And you've heard this term millions of times, but I'm about to explain to you how it works. And it's called hedging. So what does hedging mean? Well, everybody's heard it, everybody said it, but nobody understands it. Here we go. You need to do this. You need to say, okay, if mortgage-backed securities improve in price, which causes rates to drop, then I need something. Well, I'm sorry, forgive me. If mortgage-backed securities worsen in price, which causes rates to rise, that's that 4% borrower that you promised. Now rates are at 4.5 because mortgage-backed securities took a hit. They went down in price. Then what you need to do is find a mechanism that makes me money, that profits me in a way that is commensurate with that drop. So what I want to do is I want to short mortgage bonds. Okay, if you're not familiar with shorting, let's say Apple stock. If Apple stock was at $300 and you thought it was going to go down, you say, how could I make money on a stock that goes down? Well, you short it. What does that mean? That means I will borrow shares of Apple and sell them without even owning them at 300 because I think it's coming down. At some point in the future, since I have to replace what I borrowed, literally I'm short the shares. I'm short. I have to make up for it. That's hence the name short. When you repurchase them, you hope to buy them at a lower price. Let's say 200. So it was 300, it was 200. Heck, I made $100 profit when it went down. When you do that with mortgage-backed securities, if mortgage-backed securities drop, you make enough profit to cover your expense of buying the rate of 4.5 to 4, and everybody's happy. Now you have some costs, you have some hedging costs, some charges, but overall, this is how our mortgage market works, and that's great. So what's the problem? The problem is when rates come down. Now you might say, okay, isn't it the same thing when rates come down? Yes, with one small change that's making a big difference. Here we go. So rates, you lock them in at 4%. Rates go to 3.5. At 3.5%, now you're going to make a lot more money on that transaction. Whoop-de-doo, it's great, right? But because you hedged in case rates go up, that means when rates go down and mortgage-backed securities are rising in price, your short position's getting worse. Let's go back to the Apple stock. I shorted at 300, hoping it goes down, but now it went to 400. So I've lost money on that. So what you gained in the market, you lost on your hedge, but they pair off against each other and you're good. So what's the problem? The problem is this. Follow me closely, please. Now, as the short position in mortgage-backed securities, because mortgage bonds keep improving, keep going up, rates are coming down. So as mortgage bond prices do better, and the Fed is buying $50 billion a day, so mortgage bond prices go up, my short position's getting freaking crushed, okay? So because my short position's getting crushed, I'm looking at my market gains when it closes, and I'm still even on paper, except the broker-dealer gives me a call and says, excuse me, you're very upside down here and I want my money and I want it now. And I say, well, wait a minute, broker dealer, look at all the money I'm going to make when this loan closes or when these loans close. And the broker dealer says, look, I'm not going to worry if you close that loan or when you close that loan. You reach the threshold, typically $250,000. I want my money and I want it right now. It is cold-hearted and brutal. And you either pay or you're done. And this timing issue is what's killing us right now. We are bleeding. I am talking to every leader. I'm not going to say names, but I'm hearing, I just wrote a check for 55 million, 32 million, 18 million, 11 million, 8 million. The numbers are mind-boggling, and you can't continue this. Now, theoretically, if you can lay out that cash, if you're strong enough, which thank God so many are, then as you start to close the loans, you will now recover in market gain, unless, because the Fed said, oh, we cut rates to zero, that customer pulled the loan. Unless there's some bad actor that says, oh yeah, come to me, we're cheaper. Unless that customer now lost their job when you sent the VOE and you can't close the loan. Unless you got not able to close that loan in a timely manner because you got your whole staff working out of their home and they're less efficient because they got their kid tugging at them. So if Stephen King were to write this, he could not have scripted a better perfect storm horror show than what we are experiencing right now. And it is dangerous because there is only so much time that you can continue to withstand hits on the servicing side, hits on the margin calls, hits on volume levels dropping. It is a dangerous situation that makes 2008 look like a cakewalk. So this is what I want to explain to everybody out there. This is the time to not think about, well, our rate's going to get better in 2 weeks or this program. You have to think like a CEO now and not a borrower, because while I'm giving you I'm giving you everything straight up here. Okay. This is, I'm really being brutally honest with everything, even though it's scary. The good news is I believe once this virus gets better, we start to get back quickly. And I believe our industry is so smart and people are taking such amazing good measures that what we can see here is we can see a wonderful recovery. We'll get through this, but everybody's doing these things to try and survive. So please don't bitch at your company because you say, oh, well, you stopped this program, you raised rate, you're doing this. They're surviving. They're surviving for who? Who are they surviving for? They're surviving for you.
That was my point.
What good is it if you wrote $10 million in loans today if you can't close it? You can't think about in a week from now. Think about, I'm going to be in this business for 5 years, 10 years, 20 years, 30 years, and I want to be great in this business. So I'll let you comment, and then I want to give you my longer term outlet for where we are.
Yeah. I think for me, just jumping back into what I was saying before, and I didn't mean to interrupt you, is just that, I guess on the surface with the loan originators, which is by and large the people that are trying to front this information on a normal day, they're not having to know this economic level of stuff, but they need to know it right now. So that was an awesome explanation. If you didn't understand it, play it back when this gets done and listen to it a second time, because I even learned things sitting here. I always learn things when I'm listening to Barry. So Barry, we had a question. I don't know, Jason, if you're ready to read some. One of the ones that are right off the top is this affecting everybody, lender, banker, brokers, correspondents?
Yep. It is affecting everybody now. You say, well, how come this company is doing this? So that maybe they have a bigger forward commitment that they're just funding the loans into, but eventually it'll all funnel out. Everything will shake out roughly the same over time. There might be some variances and differences because of positioning for a short period of time, but it will not last more than a couple of weeks. And you'll see everybody being in the same boat unless something drastically changes.
Yeah, and one thing I want to highlight that you said, Barry,
there's no, just so you know, I just want to say, there's no magic well that somebody's drinking from. Okay? There's no, I got the secret well fountain. No, we're all in the same boat.
Yeah, and that's one thing that I think that you said that I want to call attention to about everyone complaining about rate. Everyone needs to get out of their here and now mindset. I know it's difficult. We see that all the time in the Facebook groups. Barry mentioned that about people complaining about rates in their company and products and stuff. Look, we're all in the same boat. Now is the time that we all come together and realize that if we want to have a legacy in this business, we need to have a business to have a legacy in, right? And so that's what everyone's doing right now. So I just want to call attention to that point that Barry made, because it's more important now than ever in understanding that we are all in the same boat at some level or another.
Jason, what good is a 1% rate if I can't close it? Okay, if I got
absolutely
no place to put it, if I got no, and if your company closes it and nobody buys it, how long do you think they can continue to do loans without selling?
Yeah, exactly.
So team, this is a time for you to not say, oh, it's about me, it's about me, it's about me. And by the way, I'm not being insensitive, okay? Don't think I don't know that right now your customers are pain in your ass and asking you questions. And thank you, Fed. By the way, so what the Fed is doing, just to put a ribbon around this, the Fed is ignorant about this. And they're making it worse because they're saying, oh, we're going to help. And I'm from the government and I'm here to help, right? So what they're going to do is they're going to buy mortgage-backed securities. But what they don't understand is that they're burying us by making rates go down. You heard that right. They're killing us by making rates go down, because if you paid attention to the margin call situation, they're making the margin calls unbearable because they keep buying mortgage bonds, which causes mortgage-backed security prices to go up, which causes their hedge position to get more underwater, which causes a broker-dealer to say, you better pay me before you close those loans. And then you got to write a gigantic check again and again and again and again. Yeah. It can happen every day. And how
it's compounding.
You can do this. So when you see your company say, hey, I've got to reduce the rate lock term, or I can't do a rate lock, or I've got to add more cushion so I don't have to hedge as much. They're doing this for your protection.
Right.
So what you have to do is get out of the it's me mindset and think about, okay, what can I do for you, company? How can I better support you? Not what could you do for me? It's how can I help you get through this so I have a great place to work and a great place to do loans in the future, because the future is incredibly bright. So let me just go into the future for a second and tell you what this looks like post-corona. Okay, post-corona, what we always do, and you know, guys, as I do a lot of technical analysis, I look at economic trends. You look for when you get a shock that is a shock that's different than 2008, because 2008 was a demand issue, a big slow. This is a virus that came. And that's, before I even say this, I know that when you talk to your customer, that it's a hard discussion. When you talk to your real estate agent, who, by the way, is frustrated because their income's going down, so they're hanging on that transaction and making you crazy. I get it. You can't blame them, okay? But what you have to think internally is it's not your fault. You didn't do this. You didn't create this virus.
Right.
You didn't cause this banking situation. You're not in there making decisions that are the Fed has good intentions. They just don't understand it. We're trying to get them to understand it. But if you take a step back and understand it's not your fault, just communicate the information and say, I'm very sorry, but this is where we are right now. This is nobody's fault. This is where we are. I can do the best I can, but you have to understand this is what we've got to work with right now. What does the future look like? The housing market was at 13-year highs and incredibly strong. There is much more demand than there is supply of homes. That will not change post-corona. Home values will be very supportive and you'll have a hot housing market. Now, some people say, okay, well, home prices, are they going to be okay? They're going to take a hit temporarily. Of course, that just happens during this, but this is not a hit that's long-term. This becomes an opportunity. To the extent if you could purchase a home, you will do very, very well. And remember, it's not like you're trading a home every 2 days. I'm buying, I'm flipping it tomorrow.
Yeah.
No, you're going to be in that home for many, many years, and you will be so happy buying a home during a little bit of a downturn that we might see temporarily for a few months. That is a window of chance, of opportunity. Now, let me give you some metrics. When you look at demographics, many more people that need homes, many more household formations than there are homes being built. That is a big bullish sign. When you take a look at our homes fairly valued now, if you take a look at the purchase price to rent metrics, it's an important one for future. I look at this carefully. Right now, if you take the median rent, multiply it by 17, that's the median home price in most markets. That multiple of 17 in the United States compares very well to 16.5, which is the 40-year average. When we got in trouble, it was 24. We are nowhere near that. Okay, so how about price to replacement ratio? What would it cost to replace my home? 1.59 times the cost of replacement is the cost of a home right now. For the last 40 years, it's 1.58. So 1.59, 1.58, we're right where we should be. When we got in trouble, it was around double. So it was around 2. We are nowhere near that. What I'm trying to say to you is every metric will stand for a great housing market. Now, how about interest rates? Interest rates are going to be at lower levels. If we were in a normal market right now, if we didn't have the whole thing with the corona, with the shutdown, with the job losses, with everything that's going on, you'd see rates right around 2.75%, 3%, just exactly where I predicted they would get bottom out. So this is exactly where we should be. But when we come out of this, I don't know if we get that low, because now we may have some inflation, we may have some debt, we may have some things to work through, but you will see extraordinarily low rates. You'll get a lot of refinances, a lot of purchases. Now, you might have some differences here. You might have longer early payoff periods. You might have shorter rate lock periods. You may have some changes that occur. However, you are about to have the greatest boom for a long time that you've ever witnessed in this industry. Help your company get through this hump.
That's
and
right.
You will get all of the reward at the end of the rainbow. I'm telling you, there is an end to this that's going to be great. You just have to behave yourself through this as a leader, as someone who is part of the solution, who wants to do what they can. In tough times, this is where you show your character. And right now, it's up to you to show your character here to get through this.
Such good advice. And I think everybody that's coming on here, everyone that led up to knowing you were coming on, all the questions that I, am impatient to ask, all come down to the me factor. And you said it best at the beginning of this. You've got to think like a CEO right now. And so there's been some interim times in our careers that we have to make tough calls. We have to be the front line that defends our companies and says, this is what it is, and feel strong and not apologetic, but educational about why we are here. The solution, I see some of the commentary coming up. People are saying, is the only solution, the flattening of the curve of the pandemic?
Yeah, that's really what we need. We need this virus to go away, because God forbid this virus stays around longer, and I gave you some of the scary numbers. How long can the government just keep doing this? And I know that part of the aid package is $1,200 per individual. But listen, if you're out of work and you got a check for $1,200, how long is that going to last you, really? I mean, what's that going to pay? Think about it, right? So we need to get this virus under control. Now, God willing, they typically go away in April. The medical community is doing some wonderful things, and that's why I'm so hopeful and praying to God every day that we do get for all of our good. We do get a therapeutic solution next week that corrals this damn thing and puts us in a position where we know that there's hope out there. Okay. And if you watch the interview I did with Dr. Roizen, it's so educational. What can you do? How can you boost your immunity? Why is this a dangerous virus for people who are older? It's dangerous because they tend to have more plaque in their arteries when you get above 50. And it's the high fever that the virus can cause, which causes plaque. It's those shaking chills that causes plaque to break off. And that's when you get the arrhythmias, the strokes, the heart attacks, the bad shit that happens to people. God forbid. And what can you do about it, and how can you prevent yourself? How can you do? And by the way, if you're over 50, you better be taking aspirin, baby aspirin, twice a day in warm water, like Dr. Roizen said. I follow that religiously, and you should too.
Yeah. And guys, if you got on this call late, go back to the beginning, because Barry spent a good 10-15 minutes in the beginning talking about some of the solutions. He's well connected in the health organization. He's actually had some doctors on his own lives. He broke down everything that we needed to know about how we got here, what is going on, why you need to listen to your leaders right now. We've had originators say, should I be leaving my company, cut my comp, or they did this? Everyone needs to stay where they are and grab a bucket and an oar, and we've got to get from what just Barry just said, from point A to point B, and be part of the solution right now, because we are going to recover. It's not the same market as it was in 2008 based on the demand. We will have the bounce back occur. What other questions do you have?
By the way, Christine,
yeah.
you want to know something that I think would be really great? You mentioned it.
Yeah.
It's the elephant in the room. It's a hard thing to talk about.
Sure.
What about my comp? You want to do something great. You want to be a hero in the eyes of your company and do something good, maybe at least temporarily, or maybe work out something where you look at, I don't want to plan to be an expert, and I don't want to be anybody's advisor here.
Yeah.
But here, if I were back originating for a company, I want to tell you what I would do. I would say, how can I help this situation? Can I take less comp for a period of time now? Maybe you make it up to me in the future, but I want to help you get through this, because I know we're going to come out of it if we all help. Give me less right now, because I want to do my part. And then in the future, maybe you can do something to make up for it for me. I'm not saying that you should give things up, ladies and gentlemen, but I'm saying maybe we all help each other in a way that gets us to the other side of this safely, so that we can really benefit. Maybe there's a role for that. Maybe there's a way. And forgive me if I'm ignorant on it, people. I'm just telling you what I think might be a good suggestion. So please don't send me hate mail, because maybe I'm getting it wrong somehow. But I'm just trying to find a way for us to get through this, because the other side of this is so good.
Yeah, that's excellent advice. And listen, we're going to go into wrap up mode here, because we've taken, Barry's time is like, gold. But ask your questions right now. If you have final ones, Jason will read those. I want to make a plea to everybody also behind Barry that's on this line right now, to look around you in your personal worlds right now, make phone calls to people that you know and love, make sure everybody's okay. I've heard a number of stories in the last week of people making those phone calls and discovering elderly people that were going without dinners, and young folks living alone that had problems. We have the ability to come together, that we are a strong America. And in times of crisis, this is what we do. We come together, and this is exactly why we're having this today. So Jason, what are you seeing? Any other questions for Barry out there?
Yeah. So we got a question, Barry, do you think that lenders or mortgage terms, just in general, might start lengthening past the 30-year norm?
I haven't heard that. And, when you look at amortization schedule and payments, once you start going beyond 30 years, the benefit in reduction of payment is relatively small.
Yeah.
So I don't see that as being an incentive. If anything, team, my advice to you would be, anybody whose loan you're doing now, what you really need to focus on is doing a cash out refi. Take advantage of the equity in their home to the extent you can do a loan. I understand, believe me, I get it. You have to verify a verification of employment 10 days. They might move it to 24 hours if this thing persists. So be ready for that. I get that it's hard to do, but there are equity in people's homes and they need that equity. It's trapped there. You can do a cash out refi. You can dramatically reduce all their debts. You could save them $1,000, $2,000 or more every month to make their burden less. You can give them cash for a cushion. You can make them feel safe. That's what you should be doing now. And if you do it like that, you can even accelerate payments in the future, shorten the term of their mortgage dramatically, and make people safer, healthier, and give them a better outlook in the future where they would be able to pay their mortgage off sooner and improve their retirement accounts. This is what you need to be doing right now. That's your duty to this country right now, is to help protect them into the future, to reduce their debts, reduce their payments, make their burden lighter, and give them cash as a cushion to make sure that they're safe.
And then what about Fannie and Freddie implementing 1-year prepayment penalties?
I think that's coming. Listen, everybody fights the last war, but in this case, that's just smart to do. I think that will be more difficult to get extended rate locks. And here's another thing: above par pricing is going to be more difficult too. It would not surprise me if the norm is where customers pay a point in the future. It would not surprise me.
Yeah.
Great.
And then, one thing that, I just want to circle up is I've, been connected with Barry for a while, had him speak at, our sales conference. And one thing that he's been talking about for a long time, and this goes back, 2016, I think it was, or whatever it is being that advisor, right? And I think he's not hitting you guys over the head with it and everything that Barry's talked about today. That's really what is important right now, is be a leader in your community, be a leader as a mortgage professional, be an advisor, be that expert, be that someone. So when we do get through this, which we will, we don't know what the future looks like. We're just guessing at this point, but with behind experience and expertise that Barry has. I'll tell you right now, and I said this on our live yesterday, don't listen to anybody except Barry right now, because he's been proven to be right. And, he knows that I always do that, but seriously, he's been proven to be right. He's on every live for a reason. He's on TV for a reason. It's because he has the right advice and he has the right experience right now. And these are unprecedented times. So we need to look for that. And not only that, but we got to try to be positive too, right? Because it's easy to go down the rabbit hole. It's easy to be negative right now. We need positive, because fear, and I think Sonny had posted that in there as well, fear is what is going to drive a lot of what happens right now for the foreseeable future.
You're right, Jason. I don't want to date myself, but man, I've been talking about being an advisor from the speaking platform from since the 90s. So I know I'm really old, but thanks for the kind words, Jace. I really appreciate you. You're a great leader, and Christine, so are you. And I love the both of you dearly. You're such great people, and I'm so proud to be considering both of you my close friends. And those of you listening, don't be ashamed if you're fearful, okay?
Yeah.
It's okay. I get scared sometimes too. This is something that we think about. So all you can do is what's in your control. Just do good for others. Help the people that you can. Be patient with them, because they're scared too. So show them a little bit of grace. Do what you can for your company. And just be loving. The song that we had today in today's update, you guys know we do a song every day, was Bleeding Love by Leona Lewis. I told you guys, I said, I saw her perform live. I was at Tony Robbins' birthday party. I saw her perform live. She said, I kind of fell in love with this woman. So she really has a great song that's great for this time. That's, we just got to keep bleeding love for each other. This is.
He was singing it before we came on. So
I had it on the
background. Pre-show was like the Barry dancing show. And so if he can, in light of the hurricane, the center of the hurricane that he's in. One last question that I do think I saw that I think everybody's asking is, can government buy servicing from other servicers that are rejecting right now?
Well, they cannot at the present time do that, because they are limited in the assets that they can purchase. But it is a very creative and interesting question. And perhaps if they understood this more, and that's the effort that we're making. John Malden has 2 million readers. And when I spoke to John Malden a couple of days ago and I gave him the explanation that I gave you, he was just in total shock. He said, Barry, we have to get this out there. There's an article I wrote. It's in MBS Highway. It will be in John Malden's Thoughts from the Front Line. That goes out to 2 million people. And most people in government read this at the Fed. So I'm getting pinged here from Nicole. She's saying, okay, you got to go.
Yeah. We've got to, we're getting the what is that? The yank off the stage.
I appreciate you.
So
I appreciate Jason and Christine. We all appreciate you so much. Thank you. You are doing so much good out there and helping people so much. And those of you that are listening, I can't even tell you how much I appreciate you. You guys have been very, very kind to me. And let me tell you how much that means to me and my whole team here. By the way, this is not just me. We have a team of people here at MBS Highway. And really, we've just turned our focus on to trying to get information out there. We're not worried about anything else, but try to get the best research and information so that we can provide that to you, because this is bigger than all of us. We just want to help. And I hope that everybody out there knows that, that's what we have to do for each other now. And I know you do in your heart. So, so we're going to get through this. Okay. I love you guys, and I'm going to go.
Yes,
right.
thank you
Thank
so
you,
much
Barry.
for being here, Barry. And we'll close out and tell everybody to follow Barry on MBS Highway. He is incredible. We thank you all for coming on today. We know we still see questions coming on, and we'll get on Facebook afterwards. We'll do our best to answer those if they were not answered.
join the MBS Highway Facebook group, right? Barry's always commenting in there. Nicole, Megan, everybody is always commenting and posting content, and I posted it in the comments. Join MBS Highway, subscriber, and don't take my word for it. Ask originators that are members and see the value. I've been lucky enough to been in it for a while and for years. And I'm telling you right now, that's where I go for my data, what I look at, listen to Barry's updates, get that information. And, there's right now, that's what you need. You need to be armed with information that you can provide value, not just to referral partners, but to consumers at large. And this is the way to do it.
Yeah, bring your communication up high frequently and put it out there. There was a question on here, who's going to fare better in the mortgage world? And I'm going to tell you, everybody's in the same boat right now.
Everybody's in the same boat.
There's no there's no sector of our business that is affected more or less by any of this. We are all in the same boat. So anyways,
and that's another thing. Sorry, just real quick. And that's what Anthony Costa's been talking about on his videos, right? Saying, look, we're all in the same boat, broker, retail, it doesn't matter.
Everyone's hurting.
Look, it's servicing on the back end. People are talking about banks or whatever. Who do you think buys the loans on the back end, right? Like, we're all interconnected. And I think if you didn't know that before, you know that now, that we're all part of the same ecosystem at one level. One may be doing a little bit better than the other, but at the end of the day, the water all goes into the ocean, and that's what we're dealing with right now.
We should all want each other to survive at this point, and do our best to hold, the dirt beneath our feet right now. So, listen, we wish you all well. We thank you for tuning in. We're going to keep trying to bring relevant live Facebooks out to you over the weeks ahead, as we know that you need a lot of information in the industry, and we are a media for the industry. So thank you for tuning in to Mortgage X and 2020 Vision for Success. We wish you all well. We send our love. God bless you all, and stay active, stay busy, and stay strong. Take care.
Stay safe.